We have managed dedicated credit at PIMCO now for over 25 years with a strong track record. High-quality bond yields are attractive today, both absolute and relative. Yields are now near 15-year highs, and bonds look very cheap, particularly relative to equities. Importantly, there's a catalyst. With economic growth slowing, we believe central banks like the Fed are likely to lower rates. In our view, investors won't be able to get these yields 1 to 2 years from now. With a global credit portfolio management team of 40 portfolio managers and 85 analysts around the world, PIMCO is uniquely positioned to capitalize on the global opportunities in the public credit markets today.
As Mark mentioned, even within leveraged credit, we're seeing elevated yields today. I think this is an important trend on a go-forward basis as these markets are definitely converging. We now see the private credit market at almost $2 trillion in total size. It's larger than both the high yield and loan market in total size today. And importantly, they still have about $500 billion in private capital that needs to be deployed. Given that we're seeing limited opportunities in the new issue market today, they're looking to deploy that capital in the public markets. And that's having a positive impact in the sense that it's taking out lower rated borrowers and muting the default activity. We think this is a trend that you're going to see on a go-forward basis.
We see significant opportunities today in the global credit markets through active management. Today, we are positioned to capitalize on areas of the credit market which should benefit from deregulation, such as banks and select investments in the energy industry. We find value today in areas which have secular tailwinds, like the aerospace and defense industry, given large order backlogs and rising global defense budgets. Finally, we find select value in non-cyclicals, such as telecom, healthcare, and utilities, which should offer defensive and resilient characteristics should economic growth slow. We remain defensively positioned and are more cautious on cyclicals, like home builders, appliance manufacturers, retailers, and autos, given today's poor affordability for home ownership and margin pressure expected from tariffs.
As Mark mentioned, there are some specific credit opportunities within certain sectors, but we also think ultimately there'll be a new issue counter that develops this year. However, we do balance that against the backdrop of increased uncertainty come from tariffs, which may ultimately delay these deals to come to the market.